everybody, and welcome to another episode of the Trusted Trustee podcast. And as usual, I'm joined by Tracey Besters in the Southern Highlands. How are you, Tracey?
I am very well, thank you, Darin. You missed the word beautiful Southern Highlands today. It is a beautiful day down here, so I'm doing fabulous.
Well, I just assume it's beautiful. It's always a little cold for me, but I just assume it's beautiful because it is a beautiful place.
Always
Absolutely.
very cold.
And of course, this podcast is brought to you by Superfund Property Valuations. Take the tension out of tax time by making Superfund Property Valuations your number one choice for all your SMSF property valuation requirements. Order a report today by filling in your details at www.superfundpropertyvaluations.com.au and let Superfund Property Valuations take care of the hard work. And of course, no doubt Will Spark is working feverishly there in the lead up to the 30th of June, and his work will no doubt be cut out for him as we progress towards the dreaded 30th of June 2026 when that horrible Division 296 tax comes in. But we're not here to talk about that, thankfully, today. Tracey and I have just returned from the SMSF Association National Conference for 2026. So while that policy dominated discussion, we did have a few takeaways from other sessions down there, which has piqued our thoughts about other things that we can discuss. So we're going to do that today, not bore you with Division 296 anymore, because as I
Yeah.
said, we're kind of sick of talking about it anyway. So we're going to talk about related party transactions, and
Hmm.
these are actually quite tricky. So
Yeah.
we're gonna talk you through some of the quirks in the system that you've really got to look out for. And
Yeah.
I suppose, like anything, a good place to start, Tracey, is to emphasize how critical documentation is in these circumstances, because there is nothing more valuable than an audit trail when it comes to SMSS, because when
Yeah.
things go wrong, you need to be able to follow the trail to see what actually happened.
Yeah, and that's exactly where the auditor and the ATO will start, Darren. So, and even your administrators, like they want to know what's happened in terms of your paper trail. And it was lovely to spend some time with you in person before I get started in Adelaide last week, Darren. So it was nice. It's always nice when we can come together and, see each other in person as opposed to just across a Zoom. So that
Hmm.
was nice. We had a good time at conference. It's always a big week in terms of the learnings and trying to pick out some of those gold nuggets, I guess, and some of those little things that we can share with our audience and things to take back into for me into my my private clients and to really say, well, what do we need to apply from conference? And you're absolutely right. There was a whole lot of talk about that thing we don't want to talk about. So I'm not even going to mention the name of it. So as expected, there was a whole lot of that, but we did have some little things around related parties. So documentation when it comes to any dealings that you're doing with yourself and your SMSF, the documentation really becomes the crucial part of that, that practical kind of, paper trail that we need to follow. And the reason, I guess taking another step back, Darren, from my perspective, the reason why related party transactions are so crucial or getting them right is so crucial is because of the implications of something being non-arm's length.
Horrible.
Um, we went through a whole conversation for so many months and years actually about non-arm's length. So we got sick of talking about that as well. But we kind of forget about these the practicalities of making sure that something is at arm's length, even if you're dealing with a related party. So I guess that's the crucial part. And how do we make sure that something's at arm's length, or if it's not at arm's length, what does that mean, for the fund?
Yeah, we always say that a lot of these issues are intertwined, and obviously
Yeah.
they are, because we start on one topic and we have to include another along the way. But Tracy raised a really good point, because you really don't want to trigger the non-arm's length income or non-arm's length expenditure rules, because really
Mm.
the penalties are extremely severe and completely erodes the concept of investing through a superannuation fund as a tax effective measure because all that goes out
Yeah.
the window. If you get caught by what we refer to as gnarly non-arm's length income,
Mm.
you're up for top marginal tax rate in most situations, and it's just a nightmare compliance wise because then you've got to treat the asset differently. And I'm not going to go down the whole rabbit hole, but
Yeah.
it just triggers a whole other set of circumstances that you eventually have to deal with. And of course, you don't have to deal with, you don't want to have to deal with those because extremely costly and extremely inconvenient. But I suppose
Yeah.
we should. Oh, sorry, Trace, you go.
No, no, and I was just going to add to that, Darin. Most of the time is probably the best way of describing it. Most of the time, these can be avoided as well. The ramifications of non-arm's length can be avoided most of the time if you actually just take a step back. So we definitely have to remember the hats. We talk about wearing different hats. And if each and every time we're going to do something with our SMSF, and we've got some examples that we'll work through that did come out of conference last week. If we take a step back and we say, if I was dealing with somebody that wasn't related to me, how would I approach it? And we think about our SMSF hat and our personal hat. If we actually just, paused for a moment and actually thought about it and made sure that the documentation was in place, we'd avoid these problems. It's just sometimes we forget that we've got these two different hats and we should be dealing with somebody else. Like we should be thinking about how we deal with somebody else and applying that to how we deal with our SMSF. Because I don't know about you, but I'm nowhere near generous with other people that I might be with myself, right? So
Yeah.
if they owe me money, then they owe me money. I'm not going to just forgive that. I'm not going to just be relaxed about that.
Yeah, it all comes down to that whole separation of assets thing, and
Yeah.
that can be a difficult discipline to maintain, obviously, because
Mm.
it's just you, as you say, it's you, but with different hats on. So you can't be like
Yeah.
the Canadian band who sang "Safety Dance," Trace. They were men without hats. SMSF trustees cannot be men or women without hats. I just thought I'd throw that in.
Exactly.
Anyway, probably a
Good
good place.
connection.
A good place to start might be a common scenario where you have a rental property in your
Yeah.
SMSF and the tenant is a related party.
Yeah.
Uh, Pretty simple rules to follow there, but again, familiarity can sort of breed a little bit of laziness, I suppose you could say.
Yeah, that's true, Darin. And of course, we're only talking about commercial property in this situation. So business premises, some sort of factory, office, retail premises, because we know that we can't have a residential property leased to a related party. That would be like massive no-go zone. So we're talking commercial properties, business properties. When they're rented to a related party, we've got to make sure that we're dealing at arm's length. So one of the circumstances that comes up, and I think this is where we tend to get it wrong. So let's say, my SMSF has rented a property to my company. It's been in place for quite a number of years. So at the very beginning, we got the lease drawn up. It was all, we got a market assessment of the rent. We did all of the terms, in market sense. So we've got CPI increases. We've got the outgoings paid for, we've got the rental bond is covered, all of the normal things that you would expect to have done. But what happens at the end of that lease term, Darin? At the end of that lease term, unfortunately, in practice, what tends to happen is we just keep paying the rent. We just keep paying. Maybe it was at the last CPI, but we just keep paying. And we think, well, as long as we've paid the money into the SMSF bank account, Bob's your uncle. I actually have an uncle called Bob, but anyway, that's another story. Bob's your uncle and we're going to be, quite fine. The problem is that sometimes those lease documents actually have specific requirements at the end of the lease term. For example, if your lease agreement says at the end of the term, you have to go to market rent and you're still doing CPI based on the prior 12 months, well, are you actually still in compliance with your legally binding lease? Maybe, maybe not. And if you're not in compliance with your legally binding lease, you're not dealing at arm's length with yourself, then you may have actually inadvertently triggered a non-arm's length transaction. So it's these little things, Darin. It's not big things. It's these little things that we can sometimes, get caught out on. And the other question that comes up in that regard is if you have just a month by month lease arrangement, well, should the lease be the market value of the rental income and the lease income, should that be higher than if you're on a fixed term lease? Short-term rentals are often higher in terms of the amount of rent because you're not locked in for the next 3 years. So you must make sure that we go back to that market value and make sure we understand the documentation that we signed, 5 years ago.
Yeah, I mean, the principle's no different to if you were leasing it to an external party, basically.
Yeah,
You've
yeah.
just got to apply the same rules to yourself. And as I said at the start, it's a difficult discipline to be in because
Mm.
I mean you're basically paying the money to yourself, really, but just in a different sort of structure. And it's
Yeah,
easy to get
absolutely.
complacent with that to say that, oh, I know the lease is up, but you know, I'll get to it. I'll get to it. I'll get to it. And I'll get to it turns into 5 years later. Well, Darren, didn't you do? Oh, no, actually, I didn't.
Whoopsie.
I didn't. I
Whoopsie.
didn't get onto it. And of course, there's a little bit of confusion also sometimes. I've heard questions asked in briefings as to the confusion between the valuation of the property and the lease.
Yeah.
Not understanding, oh, well, if I have to have it valued every year, does that mean I've got to update the lease every year? Well, you don't because the lease is like a normal lease document. Just like
Yes.
any other lease document. I mean, if you sign a lease, I don't know whether or not listeners own their own homes or are renting, your lease agreement is the same. You sign it for a
Yeah.
fixed term and then it gets reviewed. An
Yes.
SMSF property is no different to that. But there is confusion around that, Tracey. I know a lot of people ask that question at briefings when it comes to this subject.
Yeah, absolutely, Darren, they do. And I think that it's just a matter of we don't surprisingly to us, Darren, our listeners and people who have their SMSF don't think about their SMS every day. They don't think about it every single day, which, surprises me. I can't believe people don't wake up in the morning and go, "Oh, how's my
Oh,
SMSF doing today?"
what's wrong
Like
with them?
they have lives outside of this industry and outside of the SMSF, unlike us who don't have a life outside of the SMSF.
Correct.
But that's all we talk about. But we get busy doing other things. So keep it though, just making sure that we've got the arm's length terms covered off in our lease agreements. And it's just a little thing that can, trigger unintended consequences. There was another example, though, that was used at a workshop that I attended last week, Darren, that I wanted to share, because it's also related to, owning a property, an SMSF owning a property. And let's say that you need to replace the, split system air conditioning. So, on a Saturday morning, Harvey Norman's got a sale. The SMSF needs to replace its split system. So, Darren, you go down to Harvey Norman and you say, "Great, I can get this deal, but I've got to pay for it right now." So you whack that, split system air conditioning, a couple of grand onto your personal credit card, and then you get the receipt from Harvey Norman, and the receipt's in your name. So, but wait a second, that's for the SMSF property. So, who owns the air conditioning unit at this point in time? Do you own the air conditioning unit, or does the SMSF own the air conditioning unit because the paperwork is in your name and not the SMSF? So, if the SMSF was you were the trustee of the SMSF, that might be easy to go, "Oh, well, it's, SMSF property." But if the paperwork and the invoice is in your name as an individual and not in the SMSF name, then we do potentially then have a trigger where we have bought property on behalf of the SMSF and we're transferring that property or that plant and equipment, being the air conditioner, to the SMSF. Maybe we've breached then Section 66, which prevents or prohibits that sort of behaviour. So little documentation things. So best to always have invoices and receipts in the name of the SMSF, not in a personal name, to prevent any kind of, issue around that. And then let's add on to that a little bit further. So you've popped it onto your credit card. At what point do you have the SMSF reimburse you? Do you wait until your credit card statement comes through and the payment's then due like 55 days later or whatever it is, up to 55 days later with interest free? or do you have the SMSF reimburse you immediately? What does that look like? So best practice is always to have the SMSF reimburse you immediately because you've paid for it on behalf of the SMSF. The longer you leave it, the more difficult it's going to be able to prove based on the documentation that this actually is an asset of the SMSF and not something for you personally.
Yeah, the longer you leave it to, it's a bad look.
Yeah,
I hate to say that, if the ATO ever scrutinize the transaction, they will always look at, you know, well, how quickly did that whole transaction get finalized? It's a little bit like if you do make a mistake and you
yeah,
pay something out of the wrong bank account when you're dealing with SMSFs. And I know a technical expert who did this himself, self-confessed he did it. But what he did was he rectified the mistake the day after, I think, immediately. Um, and obviously provided documentation. And of course, that is one of the things the ATO always says is, look, if you do that, it's obviously a mistake. But like
yeah.
we can see that it's a mistake. If you left it for
Mhm.
6 months or 12 months, then it's like, yeah, look, mate, we're not convinced that it's a mistake. That might look like a loan or something like that. And then you're in all sorts of trouble again. But Trace, I will say this, it is the point that you've just raised is particularly relevant these days because
Mm.
call me a dinosaur if you want. It was probably a little bit easier to maintain discipline, even 12 to 18 months ago when most cash management accounts with an SMSS still provided you with a checkbook facility. So
Yes.
obviously you could take the checkbook and you could write a check out. I don't know whether or not it's a
Yeah.
deposit for a property or the air conditioner or whatever. It's
Yes.
easier for the SMSF to pay directly for that transaction. Hopefully,
Yeah.
the vendor will accept a check
Yeah.
from the self-managed super fund. But now everything is turning electronic. So even if you
Yeah.
wanted to do that, and I correct me if I'm wrong, Tracy, but I actually don't know whether or not any of those cash management account facilities come with a credit card or a charge card for the superannuation fund. So
Yeah. They
if
definitely don't
you,
come with a credit card because that would be a
yeah,
borrow.
so
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 yeah.
you make a really good point, Trace, because
Yeah.
it's actually become even more difficult to get that sort of compliance into line because in a lot of ways you actually don't have any choice but to pay for, in this example, the air
Yeah.
conditioner on your own
Yes.
credit card. You
Yeah.
actually don't have any choice. So
That's right.
you actually do have to be very conscious of that now because it's actually been made even more difficult.
100%, Darin. So there are some SMSF bank accounts that might give you like a debit card slash key card in the old terms. But certainly we can't get a credit card because that's a borrowing, right? So
Yeah.
and some people might be going, oh come on, Trace, it's a $2,000 air conditioner. It's really quite immaterial in the sense of the SMSF, blah blah blah. It's not going to be a problem. The auditor will be fine. Yes, that might be the case. Look, it might be fine with the auditor. They might, tick it off. It might be okay. But sometimes it won't be, right? Sometimes it's not going to be a $2,000 air conditioner. It might be that you've renovated the entire bathroom and you've paid for all of those expenses. You've renovated the kitchen. You've done something quite big. And therefore, what does that mean for the future sale of that property if you've actually breached some of the non-arm's length stuff for the future sale of the property? It might be that your capital gains tax is then taxed at the top marginal rate and not at the concessional rate. So the best practice is to make sure, even with the little things, even the little stuff, that you get into the habit of making sure everything is in the name of the super fund. If you pay for something personally, reimburse it immediately. Don't let it go on. Don't wait for the bank statement to come through. Don't wait for 12 months at the end where your accountant has said, by the way, Darin, why have you got this receipt in your name for a $2,000 air conditioner? What's happened here? Definitely don't wait for that long. Just be on top of it. And if you've got questions, reach out to your administrators, ask them right away, and they'll help you out.
Yeah, it's just all about discipline, as I said,
Yeah, it is.
discipline
It
to
is.
maintain
And
that.
habits, right? Getting into the right habit.
100%.
Mm.
Um, it's not quite like sporting muscle memory, but it's
No.
mental memory, that sort of similar philosophy where you just keep doing it over and over again, it becomes automatic, and that's
Yeah,
pretty
exactly.
what you would want to do. But Tracy, you've actually picked up another quirk in the system, haven't you? Um,
Yeah.
Not dealing with property anymore, but maybe an in-specie transfer of shares, for example. There's a bit of a
Yeah, and I
quirk there,
can't
isn't
take all of the credit for this one myself because it was actually also talked about at a workshop that I attended, but just something that I hadn't really thought about in any great detail. So, in we know that Section 66, and I've harped on about Section 66 a couple of times today, and that's basically saying that an SMSF cannot acquire an asset from a member or a related party of a member unless it meets one of the exemptions. And one of those exemptions is, of course, business real property. And we've talked a bit about business real property on the podcast before. But another exemption is a listed share. So, share listed on the stock exchange, you can acquire those shares from a related party into the SMSF, but it needs to be at market value. So the little quirk here is if you do an in-specie transfer, and what that means, Darin, is that under a normal transaction, you're selling your CBA shares to me. You would want me to pay for those shares, I would
it?
imagine. I don't think you're going to gift them to me. So
No,
you
I
want
wouldn't
me
be.
to, no?
No,
Damn.
I'm not
So
that
you want
generous.
so you want me to pay for those shares. So in a normal transaction, I would transfer my CBA shares to the super fund and the super fund would give me cash, right? But we can do an in specie. So provided we can meet the requirements of a contribution, so the super fund can accept a contribution on behalf of us, and we have available cap space in concessional and non-concessional land, then we can do an in-specie transfer. So rather than the super fund giving us money for those shares, we just treat it as a contribution. That's effectively how the in-specie works. Let's just say that I don't know what CBA shares are trading at today, but let's just say not CBA, but let's just say that those shares we're going to transfer into our super fund in our off-market transfer paperwork. Let's say that we put in that they're $1.20 per share, but the market value of those shares are say $1.50. Well, we've actually transferred those shares to our super fund in specie for less than market value, which means that we're not dealing at arm's length with ourselves and the super fund because not too many people are going to transfer assets to us for less than market value. It's the whole premise of arm's length in the first place. So if that's the case and we do an in specie transfer, there is a provision where the Section 66 says we must acquire at market value. So we can substitute whatever value is sitting on the off-market transfer, we have to substitute that with market value. So we could have literally $0 value on the off-market transfer. We've still got to put market value in. That's for in-specie transfers. So all good and well. But if our super fund pays us cash for those shares, so they pay us $1.20 per share, we cannot substitute up to $1.50. We can't go, oops, I only did it $1.20 and now I want to pay the extra 30 cents per share. We can't do that. There's no provision for that. So we've then got a non-arm's length transaction. We've acquired the share for less than market value by physically paying cash for those shares, and therefore we've acquired at less than market value. What happens on the sale of those shares? We potentially trigger top marginal tax rate from a CGT perspective. So we've got to be really careful about, again, the documentation when we do these things, make sure that we get the market valuation right.
Yeah, that's a bit of a quirky one, and I hadn't taken
Mm,
note of that either before, to be honest,
mm.
Trace. But out of that example, it's actually really important to understand, or for trustees to understand, that if you do exchange cash for those shares into the
Yeah,
super fund, the initial transfer counts as the transaction.
yeah,
So you cannot say that, oh, don't, I should have paid 30 more cents for every share. It's too
yeah,
bad because the transaction has been concluded and it's
that's
finished.
right.
It's treated as
Yeah,
concluded and finished. So you can't just say that, oh, maybe can I just make a quick adjustment? We didn't quite get it right.
no,
Uh,
exactly.
it's very firm that, well, no, Darin, that that's actually the transaction. Sorry, mate. If you do something else, that will be considered a completely separate action to what you're trying to correct, so it won't achieve the purpose.
Yeah, exactly. And I think this whole message around this arm's length and dealing with related parties is that it really is incumbent upon, those listeners with their SMSFs, it's really incumbent upon you to understand the idiosyncrasies. And we're not saying that you have to go to the lengths that we go to, but you've got to understand what's required of you, what's required for this particular transaction to be valid. And please reach out early, like reach out as soon as you want to contemplate something, reach out to your advisors and your administrators just to double check with them. What do I need to do here? Because it's these little things that can cause massive ramifications, like you said at the beginning of the podcast, Darin. You don't want to open up top marginal rates of tax just because you should have done something, should have done A before you did B, and did it kind of in the reverse. So reach out early.
Yeah, and this doesn't really spring to mind for a lot of trustees I know because of the perception of the function. Sometimes it might even be good to speak to your auditor.
Yeah, yeah,
Like if you're unsure, they're the ones that are going to have a look at all the transactions that you've done and some of
yeah,
your compliance work. So who better to ask than them? I mean, as I said, it's a bit of a mindset. The auditing function, this is a great example, is not just a tick and flick exercise. It can
no,
actually be a proactive exercise for you to get the transaction right in the first place, so then you don't have any issues afterwards. But I know that's not
absolutely.
a common thought.
Well, sometimes we don't want to ask the auditor a question because we feel like maybe we're putting our hands up, It's kind of like the ATO voluntary disclosure. Like most people don't want to tell the ATO anything they're doing because they don't want the ATO to come in with the big stick. In my experience, reaching out to the auditors and reaching out to the ATO, although that's further down the track, reaching out, first and foremost to your administrators and then potentially the auditors has been a very positive experience. And we've been able to ask the auditor in big transactions, what are you looking for here? What documentation do you want to see so that you know that this is all okay? They'll tell you, they'll definitely tell you what they want. And then, you can easily provide that information early so that you don't have then questions to answer, towards the end. So documentation, who would have thought we would be talking about that?
Absolutely. Now, just in the last bit of the podcast, Tracy,
Yeah.
you noticed some stats that were presented about the sector. I suppose, obviously, you're not going to go to an SMSF conference without talking about the overall status of the sector. So you've got some stats
Yeah.
that give us a bit of an insight into how's it going, what shape it's in.
Yeah, and the stats that were presented by Core Data, Andrew Inwood from Core Data, they were positive, Darin. There were the health of the sector is good. The interest in SMSFs is still up there in terms of people wanting to set up an SMSF. The satisfaction of people who have SMSFs and their happiness factor was positive. So that's all very good for the industry. And there was one particular stat that kind of jumped out that Core Data have taken some ATO info and then they've put their kind of forecasting on top of it. And it basically was saying for by 2030, like at the moment, 2020, we're 2026, these last stats were done kind of 24. There were 1.15 million SMSF members. And they're predicting that if the growth continues and those who are interested in SMSF go into an SMSF, based on their forecasting, then we could be looking at another 730,000 SMSF members by 2030, which is a pretty exciting space for us to be in, Darin, in the industry. So we could have up to 1.88 million SMSF members by that stage, which would be about 15% share of the
Wow.
superannuation market. So that's pretty exciting.
It's exciting for us. That means
Yeah.
more podcast listeners, hopefully.
Absolutely, absolutely. And more things to talk about with people who are new in the SMSF space. So that's really exciting.
Yeah, I actually made the prediction, if I could be as bold enough to say this, but in 2008, I think I made the prediction that superannuation would travel down a path whereby we'd get to the stage where less engaged individuals would probably belong to an industry super fund, public offer super
Yeah.
fund, and maybe even a my super offering because that's the simplistic side of things. And those who are a little bit more engaged, a little bit more sophisticated, and want to sort of have more of a say would actually
Yeah.
have an SMSF. So you'd have the barbell of the two options. Now, I'm not saying that I'm a genius and I'm predicting that, but in a lot of ways, we are kind of seeing
Yeah.
the situation gravitate towards that. One other thing that was mentioned, and I know that a lot of the audience are unadvised, but the whole unadvised thing is because it's an accountant and advisor conference is
Yeah.
always mentioned, and in particular in the context of establishment of super funds, increasingly not having an advisor involved. But
Yeah.
the good recognition is that look, while it's not for everybody, most of the people, definitely the lion's share of people who are involved in the sector, are actually well informed, regardless of
Yeah.
whether or not they've got advice or not, and are doing the right thing. So it's not just like, oh, on a whim, today I'm just going to start an SMSF, Tracey. Oh, Darin, do you know what you're doing? Well, not really, but I'll be okay. There's actually not a lot of that. There's actually a good thought process and
Yes.
strategic approach to it that I think is very heartening. And it was acknowledged by the SMSF Association that
Yeah.
it's a positive for the sector.
Absolutely, Darren. And I think that people are seeking information. Those who want to set up an SMSF or have an SMSF are quite proactive these days at seeking out information, whether it's listening to podcasts, whether it's, finding something online, reading newsletters, reading articles in magazines, all of the above. There is a plethora of information available. And I guess it's just making sure that you're finding that information from a reliable source and not someone with a vested interest, such as some of our, potential one-stop shops, in terms of, those who really want to flog a particular product. So seek information widely, and you'll soon be able to find, the more quality information out there.
And of course, that's the whole reason why we do these podcasts is because
Absolutely.
hopefully you see us as a credible source
Yes.
to provide information because we'd never tell you the wrong thing to do. And we attend just about every single SMSF briefing or event that there is out there. So
Yes.
we are getting it from very, very reliable sources. And we'll
Yes.
give you the latest developments as well from those sources who often alert us to things that we don't know about.
Yeah.
Obviously, we take into account after we've been told.
Absolutely, Darren. Absolutely. So that was conference.
Yep. We'll probably have a few other snippets from conference, but this is obviously top of mind at the moment, seeing that I only finished
Absolutely.
on Friday and we're doing this podcast on Tuesday. So it's
Yeah.
very, very fresh in our minds at the moment. So we'll probably pick out one or two other things that we noticed in Adelaide last week. I know that
Yes.
I've probably got a soapbox issue that I'd like to talk about, but I won't indulge that today because we've pretty much run out of time.
Yes. So that'll be the next podcast. Looking forward to that.
Yes. So, look, just thanks again, Tracey,
Pleasure.
for doing the podcast from the beautiful Southern Highlands, I should
You got it
say.
right.
It's always fantastic putting these podcasts together with you.
Yeah. Thanks very much, Darren. And thanks again to your team.
Yeah, thanks to my team for obviously putting these things together and to making sure that they go on the social media platforms that we publish them on, as well as obviously our normal emailing system to our readership. Other than that, thank you again to Superfund Property Valuations for their continued support. It's very much appreciated. But most of all, thank you to you for listening. Again, I know I always say this. We hope you've got some important and valuable information out of it. And we hope that you enjoy listening to these podcasts as much as Tracey and I enjoy putting them together for you. So until then, travel safely, and we'll look forward to joining you or having you join us again in the next episode of the Trusted Trustee podcast. See ya.
Bye for now.